Thank you very much. Thank you all for joining us. So, Mr. Paulson, Hank, I'd like to introduce you to some of the outstanding members of the business owners community of the greater New York, Philadelphia area. These are the owners of fast-growing private companies. These are the creators of jobs. These are the creators of an economy that I know you value deeply. And they're just thrilled that you're here, so thank you very much.
Well, Louis, I'm thrilled to be here, and what I say just about everywhere I go is there's a lot of things that are disappointing right now, some disappointing things in Washington, but U.S. business has been performing better than anything else in our country. And every now and then, I'm 68, and I know a lot of current CEOs, and I know a number of former CEOs. And when I talk to the former CEOs, and some of them say, well, they're not as good as they were when we were there, you know. And I say, well, let me tell you, CEOs are better today. The jobs are the best I've ever seen, and the jobs are the toughest I've ever seen. 24/7. It's, but it's amazing how good. And so I'm just very enthusiastic about Louis and his work with small and middle-sized businesses. So.
Thank you, sir. So, you know, for a person who's done a lot in your life, you have one of the easiest bios to remember that I could think of. You exit Dartmouth as an All-American linebacker. You find your way over to the Pentagon, find your way over to the Nixon White House, leave shortly after things hit the fan there, and you end up at this relatively small investment bank, Goldman Sachs, in the Chicago office. I know that mentoring is a big part of what you've learned throughout your career. So what brought you to this small bank called Goldman Sachs at the time?
It's fascinating, Louis, that you mentioned that, because when I graduated, I went to business school when I was very young. I was right out of college. I never worked in business. I had no idea what an investment bank was, and I certainly wouldn't have picked Goldman Sachs or any investment bank. I ended up, just through the luck of the draw, I had one of my professors at Harvard Business School, had a friend of his who was an assistant secretary of defense, and they'd had a little group there under, you know, with David Packard was the deputy secretary. So I went down, there was 5 or 6 of us. 3 of us became CEOs. One guy became the head of the National Security Council under George Bush, and another guy was chairman of the House Budget Committee. But we're all young kids at the time. And what I learned when I was there, so I worked for a whole number of senior people. And I found that some people really appreciated me and others didn't seem to. And some I needed a lot of mentoring, and some gave me mentoring and some didn't. And so I figured out very quickly, almost as important as what I did was who I did it with. And I picked Goldman Sachs when they were not one of the leading investment banks, but I picked it because of the people I met. There was a guy who ran the Chicago office who I knew I could learn a lot from, and then I met people like Bob Rubin and Steve Friedman and others. And I just said, gee, I'd like to work with these people. And they also told me, which I shouldn't tell here, which is I promise you'll never have to live in New York, because I thought New York was the end of the world, you know. And so I was in Chicago, and I spent 20 years there, and I turned down a couple promotions, and it was only in '94. You know, it was '94 because Rubin had left in '92 to go to work for Clinton. Steve Friedman had to leave in '94. The firm needed me to come and help run it. I told my wife I'd only do it for 2 years. It was a rolling 2 years. I spent 12 years here, and I loved it. But
well, it's not a bad town. It's no Chicago, but it's not a bad town.
Yeah.
So, but one of the things that's interesting about your career is you find yourself at the intersection of interesting places with interesting people. You find yourself at Goldman Sachs. You become the CEO around the time the company goes public. So I want to ask you this question. That's 1999. The question is, Goldman Sachs and other banks go public around the same time. They go from partnerships to publicly traded companies, and concurrent with that, the speed of business grew very quickly. The size of deals grew fast, the speed of every deal grew, and then we had big market changes, then we had bubbles, then you found yourself as the Treasury Secretary when some of those bubbles burst. What can you share with us about having watched and to some extent been part of the mechanism that created those wild markets and then finding yourself in the position to unwind it?
Well, first of all, let me say something about Goldman Sachs going public. You're wrong. Goldman Sachs did not go public the same time the other firms did. Other firms all went public way ahead of Goldman Sachs. And I think many of them went public because they saw a chance to make a lot of money. Goldman Sachs resisted that, and then what we found as the business changed and as the business globalized, we almost lost the firm because we didn't have permanent capital. And given the size of the business, the size of positions that you needed to take in terms of doing the market making role that Goldman Sachs was led to do by our clients. And so we went public. I actually had voted against going public at the time the partners decided, because I didn't think we were quite ready to go at that time, but we went. And actually, I think that going public the way we did it at Goldman Sachs was something that helped. The challenge that we had at Goldman Sachs was, how do you become as big as we were and keep a special culture? Because size can be the enemy of excellence. And what going public let us do was let us have a much bigger group of people become shareholders, because we spread the ownership very broadly when we went public. And then we maintained as much as we could of the partnership culture. And we still selected partners every 2 years. We signed an agreement with them that had their compensation, their percentage be set every couple of years. And it was very helpful to me in running the firm to have the top people running the businesses be big shareholders and be compensated based upon how the firm did. And the other thing, which we did at Goldman Sachs, and because I'd watched liquidity disappear very quickly when the Continental Bank went down, and that was a client that I'd worked with when I was in Chicago, and watched what happened to certain firms in '94 and '98 in the U.S. We kept huge amounts of liquidity at Goldman Sachs. So we had, at the time I left, we had $60 billion of unencumbered treasuries in a lockbox at Bank of New York. To get to your question about what I'd seen in terms of the excesses, when and I tell the story in the documentary, that the first session I had with President Bush was at Camp David in 2006, and he'd asked me to talk with his economic team about entitlement reform, which was one of the things that had attracted me. And I asked for permission to talk about what I thought was the possibility of a financial crisis while we were in office. Now, I didn't see anything like happened, but when we talked about it, he said what would create it, and I pointed to the complexity of securities. I talked a lot about credit default swaps and derivatives and hedge funds and so on. I didn't talk about the mortgage market. And when he said to me, now what will cause the crisis when it comes, I remember saying to him, I don't know, sir, but after it happens, it'll be obvious with 20/20 hindsight. I didn't see the Russian default. I didn't see some of these other things. But it was clear to me that excesses had been building up in the markets.
One of the great opportunities for us to have you here, Hank, is, as the documentary shows, you're a leader who dealt with crisis. And one of the issues we all faced, we certainly faced it in 2008, 9, 10, 11, but we face regularly as business owners how to be clear and decisive during challenging times. When you joined the Bush administration, 2006, publicly, as you had to, you shared that the financial system was sound in a lot of testimony.
Yeah, right.
And privately, there were some things deteriorating, and as you said, you shared some of that with the president at the time. What's your advice to us? What's your own experience on how to publicly assure the people who are looking to us, while privately dealing with the realities and sometimes the terror that's being created by our actions?
Well, generally, which is I think everyone here knows, because you've all dealt with them. I dealt with crises before I came to Treasury. And when people say, well, it's much bigger because you're in this big fishbowl and the consequences are so big, I said it's not that different, because when you're boiling in oil, it doesn't make much difference if it's 150, 180, or 200 degrees, right? We all went through this together. And every businessman knows, as I just was saying to someone earlier today, you never have all the information you need when you make a decision, ever. If you do, it's too late and you're looking in the rearview mirror. And the other thing you got to know is how many of you, when you've got a big, ugly, messy problem, there's never going to be a neat, perfect, elegant solution, is there? There just plain isn't. So when you're in a crisis, you're always trading off doing something with some that you don't want to do that's got some negative consequences with the status quo, which is doing nothing, which could be worse. So you've got to be prepared to make decisions, but if you get new facts, then reverse course. Now, as Lewis pointed out, in the financial markets, there's the other issue, which is you don't want to cause panic. You don't want to bring about that which you most fear. And I had all kinds of examples of this that I had to deal with. Like, for instance, after Bear Stearns went, we learned that we did not have the emergency powers to deal with a disintegrating investment bank. We had them for banks, but not for investment banks. You could not, no power to guarantee or put in capital. So the only reason it worked was we had JP Morgan as a buyer. So right after that, right away, we focused on Lehman Brothers, months ahead of it, tried to persuade them to raise capital, but I went up to Capitol Hill and sat down with Barney Frank, with Ben Bernanke, and we explained the problem. And Barney understood it immediately. And he said, but you'll never get these authorities from Congress. You've got no chance of getting them unless you go up and say, guess what, if we don't get this, we're going to lose an investment bank like Lehman, and it's going to be a disaster. Of course, then you would bring about that which you don't want to happen. And when I was up getting the authorities from Congress, part of the problem I had in communicating to the American people that what we were doing was not for the banks but was for Main Street was I didn't want to say, hey, guess what? It's really, really going to be bad when you're in the middle of an emerging panic. And so Rahm Emanuel, at the time, who's now the mayor of Chicago and played a very constructive role in this, said to me, listen, you've got your markets and we've got ours, and you're not going to get the vote unless you start to explain how bad this is. So communication, when you're dealing with financial markets, it's an order of magnitude different than when you're dealing with other things, because financial institutions are very fragile, and there's no bank that needs to be too big to fail. But during a crisis, almost any bank of size is too big to liquidate immediately. Now, we didn't have the authorities we needed, so you had to prop them up in their current form, which made the public understandably very angry. And they shouldn't be propped up in their current form when they fail, but we didn't have all the tools. But again, financial markets are different. What you least want is panic.
Right. You have some wonderful, I call them immutable rules of leadership in crisis, and using force that matches the situation.
Right.
And so you go to Congress in 2008 and you ask to load up your bazooka with $200 billion of capital to send the message that the government stands behind the banks. And you're shoring up Freddie and Fannie at the same time. We also know there were some moments in there where you took members of Congress into private meetings and you explained to them the situation. You sold them on what you saw happening. What did you tell them in that room that gave the impression that if this $200 billion bazooka wasn't loaded up for bear, the worst would happen?
Well, I would say maybe the better analogy, the story would be, and I'll come back to the bazooka in a minute because that's a little bit a different story. But at the time, I'm not, as anyone that has listened to my speeches, it can be painful to hear me read a speech. I'm not a stirring public orator. I think I'm pretty good in small sessions or non-public sessions or So when I would meet with the Republican caucus in the Senate or the Democratic caucus, which I did, I remember after the, at the time of the TARP, just explaining to people at the end of the day, just simply saying, I had some senators saying to me, Hank, I remember one saying, I talk with some constituents, and including some banks, and they say we don't really have a problem. And I had another one say they didn't have a problem, it was just the accounting rules. And yeah, I didn't laugh because it wasn't funny. I just basically said, listen, I didn't ask for this job. I turned it down twice. I'm here to serve my country. You need to trust me that I know more than you do about this, and that if we don't get the powers we're going to need, it's going to be a disaster. And I had a number of them tell me that made a big difference. Now, I also tell the story that when Ben and I, Bernanke and I, went out and met with the leaders, the House and the Senate, to ask for the TARP authorities, and when we explained that the financial arteries were frozen, the economy was going to turn down no matter what we did. But if we didn't get it, it was going to be a disaster. Barney Frank, who was terrific during this, immediately understood it. He said, this is going to be a very difficult vote because you can't prove a counterfactual. And it was late at night. I remember asking him what a counterfactual was, and he just said, you'll never get credit for preventing a disaster people didn't see. And so it will be a very, very difficult vote. Now, the bazooka story was, I didn't, although we ended up putting $200 billion in, I really thought we needed unlimited authority. And I was told you couldn't ask for that, so we asked for unspecified, if you look at it. And we got unspecified. And but at the time, people think, well, the Treasury Secretary's got all these powers. But the Treasury Secretary didn't have regulators that could go into Fannie and Freddie. We hadn't had a chance to look at the books. Their regulators said they were adequately capitalized. I was actually quite hopeful that if we had these powers, we wouldn't have to take the bazooka out. But what you find in a crisis is that the market immediately goes, or a lot quicker than you'd like it to where the most cautious investor is. And so what happened was the situation got worse, and we had to take that out and put them in conservatorship. And I was criticized for that, but I think one of the reasons why I'm able to look back now when people say, did you make big mistakes? I said, we made plenty of mistakes, but I look back and I think we got the big things right. And the reason is when we made mistakes, we corrected them right there on the battlefield. And we did the same with putting capital into the banks after TARP.
So that's another one of your sort of immutable laws of crisis management here is when you make a mistake, admit it and change course quickly.
Yeah, yep. So I think with financial institutions, you need to act with force as quickly as possible. And we had one arm tied behind us because we had this antiquated, balkanized regulatory system that hadn't kept up with the financial markets. And we didn't have the authorities we needed, and we had a problem that still exists. It's better today by far, but we still have 5 regulators falling all over themselves, competing with each other, which makes it very difficult to get things done. At least now, all the big systemically important banks at least have one common regulator, which is the Fed. When we were there, you had, Countrywide, WAMU, IndyMac, AIG, all with the Office of Thrift Supervision, regulating them, which was in many ways like no regulator.
Right. One of the other rules of crisis leadership that you share with us in the documentary is And you mentioned this earlier. Don't look for pretty solutions to ugly situations.
You can look for them, but you just won't find them. And if you think they're pretty, you're missing something.
So one of the uglier situations was similar to the $200 billion bazooka. $700 billion in TARP money is raised,
Yeah.
which is an incredible accomplishment that you got that done because you'd already sort of walked down the primrose path with Congress and then went back for the $700 billion tranche. You bring in the biggest of the big bankers to DC. You sit down with them and whatever goes on behind closed doors, but you explain to them how you think their taking hold of this $700 billion of TARP will send all the right signals to the markets.
Yeah.
A lot of things happened. I'd love to hear you talk about what happened after that and ask you to reflect on what you sent their marching orders, what the marching orders were for that meeting and what came out of it and what you could learn from that.
Yeah, well, I would say, to me, of all the things which are as close to a really, really good decision, that really comes the closest to it. The two things we did which were the most impactful by far were, first of all, putting Fannie and Freddie into conservatorship because they were 9 times larger than Lehman. And imagine if they'd gone, or if we hadn't had mortgage funding during the crisis. Now, the fact that they still exist today is a different story. You know, in 5 years, we're sowing the seeds for another crisis, and my blood boils when I just think about the fact that they're there. Now, what we did with the TARP was really quite innovative, because the reason I had been against putting capital into banks, I had been thinking about putting capital into banks the way it had been done every time before, which is the Great Depression. You put preferreds in after they'd failed. But what the Japanese did, what the Europeans did, was when banks, you let them fail serially. When they fail, you nationalize them. And so what we did, we came up with an idea, which is put capital on very attractive terms. And if you could get 9 big banks to take it, then you go to the next 25 and you go out very quickly and you recapitalize the industry. Now, when you look at our banking system and why the stress test worked here, why it hasn't worked in Europe, why it didn't work in Japan the way you wanted it to work, is because they nationalized the banks. So we went out, we broadly recapitalized them. Now, we got criticized because we weren't tougher with the terms. And of course, if we were tougher with the terms, they wouldn't have taken it. We could have nationalized them, done. We got criticized because we didn't make them lend, okay? And how does a government make a bank lend? You tell me. And and as I said, more than what? More than they were lending in the bubble, or more than they lend if they'd failed? It's sort of silly. Or we got criticized because we didn't make them say where every dollar went, even though they filled out forms every quarter in terms of what their lending was. Anybody that's a banker knows, how do you trace a dollar of capital through when all dollars are green? But so we got soundly criticized, but we recapitalized the banking system. Now, and the market reacted very, very well, but I was quite taken back when even after we'd done that, that Citigroup started to wobble. And if they'd gone, they had $500 billion of deposits outside the United States that didn't even have a FDIC guarantee. And they were $2.4 trillion, and it would have been, but we had the tools and we'd gotten them, so we put the capital in, we did some creative things with others, and it worked as it did with B of A. So basically, what you're getting at, Louis, though, is this, that despite all this, and despite the fact that the bank capital programs, the bank and insurance company capital programs, last I looked, all that money had come back, plus $32 billion. Plus it prevented a disaster. But terribly unpopular. When I left office, there was a poll, and a much bigger percentage of the American public was against the TARP more against the TARP than against torture. And so, I said, boy, Hank, you sure did a good job explaining this to everybody. But then I realized that it's not all that bad. American people, none of us should want bailouts. You know, when organizations fail, they shouldn't be propped up in the current form. And I don't think you can ever really explain that. And so that's the other thing about leadership down here. I think the third thing, President Bush had said this is the economic equivalent of war. And our guys weren't getting shot at in Afghanistan or, you know, taking artillery fire at Omaha Beach or whatever. But they were trying to preserve our economy from disaster and economic security. And unlike a wartime hero, they weren't going to be heroes. You know, you didn't have to be terribly smart to know if I said, now who would like to work on the Citigroup rescue? And people raise their hands and, you know that the best reasonable case they get criticized and investigated, and the worst one, it fails and it's, you know, they're on Andrew Mellon's team. And so I had to keep going back to the same group of people over and over again. And these are all people that didn't have political aspirations. Because if you cared about running for office, you weren't going to work on any bailouts.
When you joined Treasury, it was, as you mentioned, they had asked you a couple of times. On the third time you considered it, one of your conditions were that you get to bring your own team.
Yeah.
What makes it make sense to bring your own team when there's a team in place with experience?
Well, I would say this, there's a lot of good experienced people. And I just asked for the ability to bring on people that I chose, whether they were Democrats or Republicans, based upon their ability. And I just had learned, as I said earlier, that you can't be a good leader unless you've got people around you. Now, I didn't. The myth is I brought a lot of people from Goldman Sachs. The facts are most of the people I put on the team I found in other places in government that had the skill sets. I found them from the State Department, a really good general counsel from the White House. And actually, when I first came down there, I only brought 2 Goldman Sachs people. One was Bob Steele, who was an undersecretary who had left Goldman Sachs, I think, 4 years earlier. So
and went on to become a deputy mayor here in New York.
Deputy mayor, and he frankly had some of the skills that I needed. He had unbelievably good people skills and was going to be really good at working with Congress. And then there was a young kid who I'd never met before at Goldman Sachs, who's now running for governor of California, who ran the TARP, who called me up. He was a vice president and said, when the President Bush said he was going to nominate me, said he wanted to work for me. I said, call me in 6 months. And then a day later, he was knocking on my hotel door. And I finally let him help me with confirmation. And but then after, when the crisis hit full force, I called several other people who were all, were former Goldman Sachs people, one of whom was in Texas, and I tried to get to join me. He'd left the firm Goldman Sachs several years earlier when I came to Washington, and he wouldn't come. And I called him and said, you don't have a choice right now. You've got to come. Your country needs you. Another one, I had George Bush call to come, and so we got the team we needed.
So tell me a bit about George Bush. You said in the documentary and in your book that he had a pretty good grasp of what was going on in the markets.
Oh yeah, he had a terrific grasp. Some audiences who don't know him, are surprised to hear me say this, but I never heard him once cite a poll or during when I brought him nothing but bad news for 2 years, do anything other than buck me up. He was a commander-in-chief who was prepared to do unpopular things. He truncated the decision-making process, and he was willing to step up and make tough decisions. He was accessible at all times. And it's an interesting thing because when I had all these agreements with him, but I knew when I came to Washington, if it didn't work, it was going to be my fault, not his, and I wouldn't be successful. And fortunately, even when I ran Goldman Sachs, I still worked with clients. So I was advising people like you. And I did that because I thought that was the only way I could run the firm well, is be out there in the markets all the time. And so even though I was a CEO, when I advised a client, they were the principal. I gave them advice, but then they made the decision. And as long as what they wanted to do was ethical, whether they agreed with me or not, we executed what they wanted. So I had a mindset that I needed to, fortunately for me and for President Bush, I had a year before the crisis hit to build a relationship with him. And fortunately, I had a year to build the relationship with Ben Bernanke and Tim Geithner, and that I'd actually had experience working with Nancy Pelosi and Harry Reid and John Boehner and Mitch McConnell, and working on some trade agreements and working on stimulus and so on. Because if it had happened right away, and that's basically what the president said to me after Citigroup when he came over. And he came over and he said, you know, Hank, it doesn't look like you're sleeping. And I explained I wasn't, and told him I didn't want to be Andrew Mellon. And he said, it's absolutely ridiculous. You know, we're Roosevelt one. We're doing the things that need to be done. And then he said to me, listen, this is very unpleasant. It's terrible that it's happening, but you should just be grateful that you're here. And because you've been trained to do this, and we should both be glad that's happening at the end of this administration, where we have a president and treasury secretary that know each other, work well with each other. He said, just be glad it's not happening at the beginning of an administration where people are just trying to figure out how to work with each other.
Yeah.
And so that was the kind of boss he.
One of the things you said to me was, in a crisis, liquidity is more important than capital.
Yeah.
And I nodded my head knowingly, but I actually don't know what you're talking about.
I will tell you this. A lot of people don't know, and unfortunately, a lot of bankers didn't know what liquidity is. Because I would say liquidity is the cash on hand you have if you can't raise other sources of money. So I would say to Fannie or Freddie or Bear Stearns, how much liquidity would you have? And they'd say 30 days or whatever. And they were totally wrong, because they were saying, well, if the markets keep performing the way they have in the future, the way they have in the past, that's what I've got. But the way to look at liquidity is to say this: if everyone that can withdraw money from you does, if every lender who can call down capital from you does, then how long can you last? And so when you have a firm like Bear Stearns that had prime brokerage accounts and managed money from hedge funds and went and made 60-day loans to the hedge funds, but we're doing overnight financing in the repo market, and just assuming they could keep going with their securities and borrow against mortgage securities that were selling for 50 cents on the dollar, borrow at close to 100 cents a dollar. That's not the way the world works. And so capital is a really crude measure, and you can have plenty of capital on your balance sheet that works for good market conditions, but during tough market conditions, when AAA rated securities or corporate bonds are not liquid, you don't have enough capital. Right. So the best way to do this, and I watched it in 94 and 98, where investment banks that were funding themselves with commercial paper or on a short-term basis got in trouble. And so at Goldman Sachs, we just said, we're not so smart that we can figure this all out, so we're going to just keep cash.
Right.
But even then, if you're a financial institution, you can't keep enough cash on hand to protect yourself from a 75-year storm. That's why I believe that no bank or financial institution that's not government-owned should ever have a AAA rating.
Right. Well, that's another interesting point, is the rating systems and that point about AAA and the government. But does that extend to us as business owners, that we talk about capital and access to capital, but what you're really talking about is what can you draw down right now in the worst conditions?
Well, I think it does, but it is not as pronounced as for banks. Although I've never seen a industrial company get in trouble because they've got too much capital or too much liquidity. And the one time I saw it impacting industrial companies is to take you back. So we had Lehman, Merrill, and AIG going down all the same weekend. Merrill got bought, and if B of A had bought Lehman, then Merrill would have gone down. It would have been worse. A loan worked for AIG because you could loan against the insurance companies that were perceived to be well capitalized and had independent credit ratings, and the market perceived it just to be liquidity at the holding company. When the market wouldn't accept that anymore, we had the TARP. But when we had the run on the money market funds, I had not just a good number of the biggest money market funds calling me and saying they were getting ready to implode. I had a good number of industrial companies call, and I was talking to a CEO the other day who was taking me through it. I remember the call I had from a CEO of a AAA industrial company, huge company, and he called and said, my treasurer says I might not be able to make, and this was Tuesday or Wednesday, send out the $800 million quarterly dividend payment I need to make because the commercial paper market has gone. And I could so quickly see, because when CFOs and treasuries are going with the very biggest companies and calling their boss and saying, boss, we may not have liquidity, so then they can't pay their suppliers. And they start cutting back on their working capital. You see how that goes through, and that goes quickly to their suppliers, to smaller companies, and then you get this vicious cycle of failures, which is I could just see it moving very quickly from Wall Street to Main Street, and that's really a liquidity.
I want to talk a bit about bubbles. You know, it's interesting, the Inc. 5000 list, the list of fastest growing companies in America, they're companies that in some ways are taking advantage of bubbles. I mean, in the sense that they're taking advantage of disruptions in the market. They're small, they're nimble, they're in the right place at the right time. What can you tell us about bubbles, their frequency, their ferocity? What can you tell us about how bubbles start, how they get ended, and what we can do about them?
To begin with, I don't care what the regulatory system is. I don't care what the economic system is, as long as you have people that give in to bouts of panic, and as long as you have banks and financial markets, you'll have excesses and you'll have bubbles from time to time. That's the first thing I'll say. The second thing I'll say is that every bubble, and you go through any situation, and I'll tell you how the root cause is in flawed government policies. The root cause. Okay, we could talk about housing policy in the U.S. and home ownership is great, but when you look at the interest rate deduction, all the FHA programs, Fannie Mae, Freddie Mac, et cetera, deduct interest on $1 million mortgage. If you got multiple mortgages, deduct interest. And so much money went into housing in the U.S. that we didn't have residential housing prices, we didn't have any nationwide decline. So ever since World War II, if you bought a diversified pool of residential mortgages, the biggest risk you had was you get your money back too soon. If interest rates dropped, people would prepay. But what that bubble does, it incented Americans to say we're going to save in our home. So people bought bigger and bigger homes. They bought homes that were too big, they didn't need them. They bought multiple homes. But you find that continually. Now, the next thing I'll say is always, after the bubble breaks, you can always find some people that predicted it. And they'll say, yep, I got it right. And those people will get it wrong next time. Because you can't, by definition of a bubble is the market doesn't understand it fully or it wouldn't be a bubble. You don't understand it until it breaks. And so the key thing is to have the tools to deal with it in the financial markets, to have the emergency tools to deal with it so you can manage it, okay? And then to keep the excesses from building up and to prevent these 75-year, 100-year storms. And I know nothing other than just basic fundamental government policy. I'm not saying the banks didn't make a lot of mistakes, because they did. And on the one hand, since the beginning of time, the banks have taken just about 100% of the blame, even though it's been flawed government policies. And again, not wrong, because they can be better and you clean up the bank's mistakes. But it is wrong if you don't focus on the root causes. Because you don't focus on the root causes, you'll be back again. But I would just simply say this, and I advised all kinds of companies when I was at Goldman Sachs, very big companies and small companies. And I would just simply say the mistake that people make is thinking that you have to be risk takers, but to think the future is always going to be like the recent past, to figure out what's a secular trend and what's cyclic. And I think what you always need to do, at least I would always do, is to say, what is the worst reasonable case? And always look at that. And when you put your capital structure in place, it's always a lot, equity is better, safer than debt. And long-term debt is a lot different than short-term debt. And if you short-term debt should be used to meet short-term funding requirements, and just very simple Graham-Dodd philosophy. And I'm very suspicious when people do anything other than that, and sometimes it works, but it doesn't work forever.
But after the consolidation of these too big to fail banks occurred, we ended up with fewer banks that have more of the assets, and therefore the systemically important financial institution problem was worse immediately following. That's one thing. It's still just as bad, much worse than it was when the crisis started.
Yeah, I wish I had the numbers at my fingertips, but these are roughly right, so don't hold me to these. In 1990, the 10 largest banks had roughly 10% of the financial assets in banks. I think before the crisis, it was roughly 50, maybe a little bit more. And after the crisis, I don't know whether it was 65 or 70 or whatever, but it increased. And so to get through the night, we encouraged consolidation, and they became bigger. Of course, size alone is not a problem as much as it is complexity. I am not saying this isn't an issue, but I'm saying that there's been a huge focus on this. That's all you read about, that's all you hear about. The big banks are not just better managed, they're much better capitalized, better liquidity cushions, that's the ultimate defense. They have a common regulator, and the regulators have the tools right now to deal with this. So I'm much more focused on the things that aren't being done. When we put Fannie or Freddie into conservatorship, they basically insured something like 50% of the residential mortgages. Now, almost 90% are insured by either Fannie or Freddie or FHA or some government entity. So that means the government is setting the price and terms. And I'm not for, I think we need something like Fannie or Freddie, but the idea that they're still there in the current form. And right now they're coining money and they're part of the budget. So there's a big cost in terms of the way that the deficit is computed if you were to phase them out. But we need to, in my judgment, say we're going to phase them out. I don't care whether it's over 5 years or longer, but we need to phase them out, and we need to know what's going to replace them. And it's going to have to be something where they're smaller, and that private market participants are taking real risk in the marketplace. So that's where my concern. My concern is Fannie or Freddie. The money market funds still haven't been fixed. And as a matter of fact, we are very fortunate. We used some authorities' exchange stabilization fund. And when Congress passed the TARP, they put in legislation, don't you ever do that again. So that authority doesn't exist, but the money markets still exist. And so I think the money market funds are great things. I'm all for them. It's a great product, but I think we need to make some changes. In the documentary, I deal with sort of the bonus question, and I did it more generically there. and that's how I'd rather do that. I don't ever like to comment on a particular company. And this has nothing to do with legality, okay, and for any of the banks, but one of the things that upset me the most was after everything the government did, some of the bonuses that were paid out, and that I just thought it showed a stunning lack of awareness of how the public looked at this, how it looked, and to me, more broadly, because basically the government did things that helped the whole banking system and stepped in. And the way financing works is the problem occurs in the banking sector before it hits every place else. And so everyone says, oh, guess we don't have a problem, it's just the banks. And of course, then it's a delay. Then it hits them, but the banks will recover before everyone else. So when the banks are recovering and paying out bonuses or, some other situations, it's just aroused great public anger, and I can sure understand why. And it was hard for me to watch it. I think it would have been hard to manage if we knew it was going to last so long.
Right.
And because frankly, I thought, we were boiling in oil from July of 2007 right up until Bear Stearns went down in March of 2008. So that was a big period of time. And from the middle of August, when we discovered the seriousness of the problem with Fannie and Freddie, and we were working to put capital in them and stabilize them before Lehman announced its earnings, through October 13th or 14th, when we put capital in the banks, it was around the clock. And then right up until I left, we were dealing with the autos and B of A 2 days before we went out the door. And everybody handles it differently. To me, I've always needed sleep. So I wouldn't stay at the office like a lot of people do all night. I would go home and I would put my head on the pillow at 9 o'clock, and my wife would say I'd be snoring at 9:02. So I'd go to sleep immediately because I was exhausted. But what would happen to me, which I really had to guard against, was waking up at midnight or 1, and in the middle of the night, particularly if you're tired, little problems seem big and big problems seem insurmountable. And so, and so those were the toughest times. During the day, when you're going all the time, and I'd look at the logs, I'd have 100 different phone calls, I'd have nonstop meetings. You didn't have time to get tired. And you were engaged and actually didn't have time to be afraid either because you were working. But you really have to guard yourself, and the way I protected myself from this was overreacting when you're tired and making a wrong decision. Even when you thought you had to make an emergency decision, quickly you need to truncate the decision-making process, but you still need to go through it. You need to have some people you really trust be devil's advocates, argue the other side, and whenever you can, sleep on it.
Do you think that the decisions were hampered because they were made so quickly, or if you'd had months to make a decision about, let's say, Merrill going to B of A, you would have come to the same place?
Yeah, I can't, as I said, when I look back on it, I think I didn't understand the full extent of the crisis until we got the capital, got the TARP authorities from Congress. But if I was omniscient, I couldn't have done things earlier, because I started working with Barney Frank on Fannie and Freddie in 2006 in the fall, and it took them almost going down to get it. Congress voted down the TARP the first time. We couldn't have gone any earlier to them. So I can think of a zillion smaller things, communications mistakes, at midnight sending the 3-page outline up to Congress for the TARP that looked like we were being high-handed, and it was just a starting point for a discussion. I should have explained that. My first excuse was it was midnight, but I had a lot of other press conferences at midnight. I mean, we could have done that, but the big things we did, we got right, And the things that were considered to be errors were things where we didn't have the authority. Like most people to this day still don't believe Ben, Tim, and I when we say there's no legal authority we had that would work with Lehman. No one could cite what it was, but they just assume we did so many things, there must have been something we could come up with. But we learned a loan. We made the loan initially to Bear Stearns from the Fed through J.P. Morgan. A loan won't save a imploding bank when everybody's pulling money out. It takes a guarantee or capital. And there just was no legal authority anywhere to do that. So I think the big things we got right. I'm not saying it's a bubble that's going to burst, because I don't see it that way, but it's a really sad situation. It's one that we spent a lot of time on during the crisis, our team working with the Department of Education, and because even though the student loans that were out there, the securities, and the government, on the hook, or really strong credits, they weren't trading well in the marketplace. But I look at it now that the cost of education, it's disgraceful how that's accelerated. And if you take a look at what's happened, entitlements, or you take a look at all kinds of other costs, and you look at what's happened to the cost of education. So the universities, I don't think, have been well run in terms of that, which has tended to price the middle class out really hard. And I'm not saying low income also, but it's easier sometimes for low income students to get scholarships. But it's priced a big group of people out. And so they've been forced to borrow. And then, to me, and I want to be brief because we're running out of time, but to me, one of the real problems we face is what's happening to jobs in America. And part of this is the financial crisis, but to me the biggest part of it is something that's secular, and it is what's going on. It's globalization, but to a much greater extent it's technology. You give me the industry and I'll show you our technology, which is a good thing and we need it. It's making all of our lives better, but it's destroying jobs. And so a lot of people are going to school, not getting the education they needed, taking out big loans, and they don't have jobs. And to me, that's a huge focus. And I see the analogy you're making, because, in the one case, people were investing in their homes, and now they've been investing in education, which is a good thing. But the question is, are they paying too much for it? Are they getting the right education? And what are they going to do if they've got jobs and they've got the debt and they don't have jobs? And that's a big problem.
We are so grateful to Hank Paulson for joining us. I'll tell you, he is actually leaving here, headed back to Chicago, packing a bag and heading out to China. So he was very kind to join us in San Francisco, where we did something very similar, and then comes here to New York to be with us. I know from my casual conversations with him in preparing for this that he is a huge fan of all of you and what you do. And Hank, for what you did during the crisis and for what you've done to share your story and your generosity with the council community, I really thank you very much.
Well, thank you, Louis. And as I said earlier, I just love to speak to groups like this, because I really do think business, there's a lot of things that aren't working well in this country, but what is working well is business. We've got the best companies in the world, and they're outperforming our government, and that's why we're doing as well as we are right now as a country. So keep it up. Thank you.
Okay, thank you, sir.
Thank you all.
Okay.
Thank you.
Okay. Thank you.